Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today is the man himself. We haven't heard from Mr. Michael Becker in a while, so the governor of the great state of Texas, unofficially, I think. Michael,
yes.
How are things going?
It's going a little stir crazy, trapped in my house, looking out the window, doing the same thing every day for a month now. But besides that, everything else is going pretty good.
Now, you are pushing out almost on a daily basis about where collections are. How were collections for your group for April?
So we are the 10th. So as of the close of April 9th, we're somewhere around 93% collected portfolio-wide, and that kind of varies by property. But overall, about 7% or so outstanding. And then today's a big day for us. We kind of put a standardized collection payment program in place where any resident that was impacted basically got 25% of the rents due today, 50% next Friday, and 25% the following Friday for April. So we expect to see some payments on those payment plans coming into over the weekend, this weekend. So I think that, overall, if you told me where I would be sitting 2 weeks ago, I'd be jumping for joy because I feared, 20, 30, 40% delinquency kind of going into this a few weeks ago, just with the great unknown. But at least for April, we'll see what Greg says about Texas and the nation. But in our portfolio, it seems like the absolute worst case scenario in my head has been diverted so far.
That's great. That's very positive. I would imagine 4 weeks ago, when this whole thing was starting to rear its ugly head, I could imagine that you had some sleepless nights and thinking about what you were going to do. And I'm sure we're going to talk a little bit about that today, especially going into May and June. As Michael said, we're recording this on April the 10th. So joining Michael and I today is the professor himself, Mr. James Zhang. James, thanks for being on the podcast.
Thanks for having me. And, definitely interesting time. So interested to hear what Greg has to say, and we'll really get into it here.
Michael, have you been listening or watching some of James's videos on what's going on?
I have. And yeah, I thought in particular his Trammell Crow or lessons from the 80s from the Trammell Crow organization was particularly insightful. So I commend James for what he's doing.
He's doing a great job.
Yeah, some of the stuff is, for the first time we've ever seen it, but some of it looks similar. So I think there's definitely lessons to be learned. And Greg, I think, can compare this to sort of some of our previous recessions and how we're going to get through this one, because we get through them all.
We certainly do. In the podcast today, we're going to speak with Greg Willett with RealPage. As you know, Greg Willett serves as chief economist of RealPage. He is the guy that all the bankers, all the guys in the newspapers and the press want to talk to, because he can. He's almost like a little bit like Karnak. If you remember on Johnny Carson, that when Johnny would have the big hat and he'd ask questions and open up the envelope and he'd have the answers. Well, that's a little bit how Greg Willett is. Greg is kind of the guy that everybody turns to. And so what we want to do today is kind of figure out what Greg's thoughts are, apartment ownership, investment, management, everything that revolves about what's going on in these trying times. So I want to welcome Greg Willett.
Hey guys, it's great to be here today. I think I usually tell you no hard questions, but today all the questions are going to be hard just inherently. So it's okay.
That sounds good. And so, Michael, I'm going to let you kick it off and let's start talking to Greg.
Well, I'll try to keep our pop culture references a little more current than Johnny Carson from the 70s. But
that's how old I am.
Appreciate you joining us, Greg. So what's new? What's going on out in the marketplace? I guess I know you've been probably having this same conversation, many times over the last couple of weeks. But what's kind of your take of where we sit right now?
As I think about it, I usually start with a little bit of discussion of where we were going into this downturn, because I think it is important to realize we were in really good shape. And particularly, we were in good shape relative to where we were going into past recessions. And just to give you some perspective on what the apartment market was doing as of early March, occupancy was 95.5%, 96%. So pretty close to all-time highs. Again, let's make that comparison back to the Great Recession in 2008, 2009. Occupancy was about 200 basis points lower whenever that kicked in. So again, we've got a little bit of cushion, not enough cushion, but we've got a little bit of cushion relative to what's happened in the past. Rents were still growing around that 3% annual mark and have been since the last half of 2016. So in good shape there. And then I think it's also important to realize that over the course of the past few years, we've been pretty conservative in the way that apartment deals have been structured. I mean, there's not over leverage to the degree that was seen in the past. And I think most of these deals were made assuming that we had some sort of recession in our future, probably not to the magnitude that we're actually going to experience, but people were making deals assuming that something was going to go wrong in the course of the next few years.
Okay, so how have you seen over the last, I guess, month? Really, we've been kind of living with this new reality almost to the day. That was when I kind of realized it when I was supposed to go to London and Paris for spring break, and the day before I was supposed to get on an airplane, they suspended travel to Europe. I think that was kind of, and Tom Hanks announced he was diagnosed, so that was kind of the trigger in my mind when everything started kind of going downhill here. So what have you kind of seen over the last 30 days or so as far as this devolving, and kind of where do we sit nationwide as we are on the 10th of April right now?
Michael, it's interesting that you brought up Tom Hanks. We can look at our data and see that the inflection point on when the world changed for everybody, it is March 12th, that there's a real inflection point with everything. And Tom Hanks announced that he had the coronavirus the day before that. And that's also when the NBA canceled the rest of basketball season. So I think it's unusual that you can pinpoint a inflection in the economy to the exact day, but you can in this one. So since then, obviously, we've had a big contraction in the overall economy over the course of the past 3 weeks. Total unemployment claims are now at 17 million or so people have filed unemployment claims. Going back to the Great Recession, the number of jobs lost was around 9 million. So we're certainly already deeper than that. To me, it's been interesting how apartment owners and operators have reacted to all this. And I see really 3 phases of action. First was to address the safety and security of the people who live in the properties and who work on the properties, and you shut down the common area amenities, and you began to limit interactions among people. You scale back on maintenance activities. And interestingly, a lot of our clients are saying that when their residents have simple maintenance requests, they're just showing them how to do the repair using Facebook. So that was an interesting development. Phase 2 was just go into business continuity and how do you operate your site virtually, do virtual leasing tours, et cetera, establish the lines of communications with the residents. And then we're now into phase 3, which is really assess the damage, what's gone wrong thus far, and then anticipate what lies immediately ahead.
So how have you kind of seen the data, or what's the data showing you as we're 10 days into the month as far as collections go? Like I said, we're about 93% kind of plus minus collected per our scheduled rental rates as we talk today. We suspect, I'm kind of putting my personal over under mark about 4% delinquency when we kind of close the month out. If we can be, portfolio-wide below 4% delinquency, I think that's a huge win overall. What are the numbers showing kind of nationally?
RealPage is part of a group of technology providers that we're all working with the National Multifamily Housing Council and feeding our data into them to do some broad measures. The first set of data that was released this week from NMHC covered really just the first 5 days of the month. And it's important to consider when you hear these numbers that that first 5 days included a Sunday when people were not going to be doing some processing on rent payments. Nationally, about 69% of renters had paid their rent in that first 5 days. And that was about 12 to 13 percentage points under the historical norm. Again, I think that having had a Sunday in there skewed the numbers a little bit, but you can start to now see some real differences in the payment activity by product class, and particularly there's some big differences by geography. And certainly looking at product class, the payment rates were pretty good in Class A and Class B product. Class C missed by a big margin.
You kind of have like the basic percentage whiff of Class C relative to historical norms, because a lot of the listeners of our podcast are kind of rolling that EMC space, workforce housing.
Again, in that first 5 days, the numbers were, as I recall, 17 percentage points under the historical norm. That was information through April 5th. Certainly our internal data, which we're not going to talk about specifics yet because we're going to feed all this through NMHC, but we see some significant catch up this week. I'll also point out in Class C, you have the challenge that a lot of people have tended to pay their rent in person for people who live in the Class C product versus Class A and B, you have more frequency of electronic payments or automated payments. So with business offices actually closed at most properties, it's a little bit more difficult for people who tend to pay in person to actually make the payments. So again, I think there's going to be some catch up, and the numbers are not going to end up as bad as these initial figures suggest, but there is going to be clearly more non-payment in Class C product than in the top and middle tiers of the product spectrum.
Hey, Greg, going back to one of your points around sort of business continuity and sort of running these properties, is there any, like a lot of operators we talked to, they've maybe gone from, let's say a 200 unit property, they've gone from maybe 4 people on staff to maybe just 1 in the office and then maybe 1 maintenance guy or maybe 2 maintenance guys. So they're basically running at, 25% or 50% of their payroll. Have you seen any operators sort of have a shift in how they're doing business now that will stay even after we're back to normal in terms of whether that's leasing virtually or providing different amenities that, the gym is closed, everything that we showed them on the leasing tour to get them to sign up is closed right now. So is there anything that you've seen operators do maybe on the leasing side and on the amenity side?
Yeah, I mean, it's interesting as we're talking to the operators pretty much every day. And you're right, they've tended to, the business office is shut down. They usually have 1 person who is actually physically there in the business office. And if you make an appointment, they will interact with you in some way. And they can arrange, hey, here's a specific time for you to drop off a rent check, et cetera. So you're right that they're very lightly staffed at this point. However, certainly we've seen that in the past, interaction with the residents and helping build those relationships is an important thing. So when it is appropriate from a health standpoint to bring the interaction back into the picture, I think that's going to happen. You talked about the virtual tours and some of the communication technology that's gone in place. I think that does stick. And we were sort of trending in that direction anyway, but we've now accelerated that. And the success that some people are seeing doing marketing sort of efforts virtually and changing the communication technologies that are used with the residents, those are going to stick. And I think that the residents like that. And again, we were moving in that direction. We're just moving there faster now.
Do you think, I mean, obviously, like the leasing guys coming in the front door is down significantly, but what about retention? Are we seeing, guys just stay in units? Is that like if we got them, we're just going to try our best to keep them regardless of rate? And so maybe talk about retention rate, and then also, are people able to get any sort of rent growth, or is this just a neutral year or a down year for rent growth?
Yeah, let me talk about that flow of new resident prospects, and then I'll talk about retention. We can sort of measure how much demand is on the way, in that we can look at what's happening with individual property website traffic. And so that came down drastically middle of March for a couple of weeks, and drop-offs in the range of 25 to 30%. It's still down, but it's down far less. We're down to around the 10% mark. And whenever I'm making this comparison, it's to what was the traffic like at the same time last year. So people looking, that's not quite, it hasn't taken as big a hit as maybe we thought it would. There is a bigger hit in terms of you reach out to the property and make some inquiry about either the product itself or product availability. That has come down initially 30 to 40% year over year. And then as with the website traffic, we're starting to see that still be down, but not down as much. And now we're more like it's off 20% year over year. And then probably the most important one is just executed lease volume. So you've gone from you express some interest to you actually sign. That is down 40% relative to year ago levels, and we've not yet seen any movement toward getting that back in line. So challenging to get initial resident demand, which is really a problem for those properties that are in lease up, I'll point out. But the flip side of that is the people who live on the properties now are not going anywhere. The retention rates are sky high, and we were already at record levels over the last year. Around 53% of the people, when their initial lease came up for renewal, they chose to stay in place. And this year, man, we're going to blow that number away by a huge margin. So priority number one is just to hold on to the residents that you've got, assuming that they're actually making the rent payments.
So it seems kind of like a barbell effect a little bit, where like the brand new deals that are in lease up or the lowest end of the property grade are the two that are kind of most impacted, and everything in between somewhere in the middle of that spectrum. Is that a fair analogy?
Yeah, you guys have heard me say this over and over again over the past few years, that we think the sweet spot is Class B product, and that at some point we would have a downturn, and Class B was best positioned to weather that. And boy, the numbers really back that up right now.
So, obviously every recession is a little bit different from the others. And this one is, certainly nothing that we've seen in our lifetime for sure. How does this kind of compare to the last big one, the Great Recession? Obviously I was a banker 12 years ago, kind of doing problem loan workout and trying to collect all the money. And I echo your previous comments. I mean, we came into this, generally speaking, in a much better structural setup from the capital market standpoint, where Fannie and Freddie and the Life Co. and even the CMBS weren't making assumptions on revenue growth, where you kind of go in these things with like a 1.0 or negative debt cover and project future growth and kind of loan on future growth, with the exception of maybe some of the debt funds out there were getting a little aggressive the last year or two. So I don't think that really, for the most part, most of the people are super over leveraged unless you potentially have some high LTV debt fund, kind of bridge loan on it. What's kind of similar so far and what's kind of different and what's kind of your crystal ball on how this is going to play out differently than 12, 10 years ago?
Yeah, I mean, as we're approaching it, we're certainly thinking about the first cut on forecast is just how does it compare to 2008, 2009. If we look at occupancy in that time period, it came down 200 basis points from roughly 94% to 92%. We think that 200 basis points is probably the minimum drop in this situation. We've lost more jobs. We have a lot more product that's still under construction right now than we did back in 2008. So we think, again, at least 200 basis points, could be more. Circle back to it's important that we're starting from 96% rather than from 94%. But we're going to lose some occupancy, certainly. And it will be interesting to see, given the market's sort of frozen right now. And then you also have the moratorium on evictions. Occupancy actually won't start to drop until the market opens back up. And so if you assume that people can be out and about again by middle to late summer, that would suggest end of this year to early next year is when you would tend to see the decline in occupancy. On rent growth or rent change, Great Recession, rents were cut about 7% overall over the course of 18 months or so. Our first swing at forecasting for this cycle, we're saying that rent cuts will be smaller than that. And we think that that reflects increased use of technology and people are going to make better informed decisions. And certainly we've seen over the past few years that people understand now that price is not your only tool when you're trying to attract some demand. You can do some tweaking in your resident background screening. You can tweak what's happening in your ability to follow up on leads, and you can adjust the marketing spend and how you're approaching attracting residents and be sure you're well targeted there. So that's our big takeaway. I'll point out it was pretty tough to do our regular quarterly forecasting this time because everything was so fluid. As soon as we put out this first round of forecasting, we immediately started working on it again. And we're going to issue a mid-quarter revision of expectations this time because the world is just changing so fast.
Do you expect any sort of shadow demand coming or future demand coming from like the people losing their homes and being forced into the renter pool that were previously homeowners, kind of like we had, 10, 12 years ago? Or do you not see it playing out similar to that?
But certainly not to the extreme that we saw in the last cycle. And I will point out most of those people who lost their homes and came back into rentals actually came back into single family rentals. They did not end up renting apartment units for the most part.
Hey, Greg, you were interviewed, I think, by like Globe Street, and I thought there was it was like in March, and you had like sort of 4 things here that people should be doing. And I thought maybe you could touch on a couple of them if you don't mind. Number 1 was avoiding panic. You talked about revenue management, outperforming just sort of, the leasing agent deciding on the strategy, and then also locking in renters on longer lease terms. So can you maybe touch on a couple of those for us?
Yeah, certainly number 1 is understand what is your actual business strategy as we go into this. And that's going to be different for different kinds of owners and operators. I mean, there are some who are very dependent on cash flow. There are others who, if taking some renters who are challenged to pay is going to do some long-term damage to your rent roll, is it better to just let those units sit vacant for a while? So you got to understand what your actual goal is and structure your activities to do that and make big picture decisions on how you're going to approach it versus, one-off decisions for every possible individual renter. And then to your point of understand the importance of those relationships with the residents that exist, because clearly there's going to be challenging in getting additional people in the door. You have to, and I would say this is a something that's true for every single owner and operator. You have to focus on holding on to the people that you've got. That's the best way to protect your revenues at this point. And also understand that if you have expiring leases among your existing resident base at this time, it's probably better to just keep their rents flat and hold on to that. And even if they're forced to stay in place and they would pay higher rents, if you force that, it's that relationship. You gotta maintain that reputation that you're willing to work with people in this trying time. And again, for those who are missing rent payments, get them on a payment plan right away. And as you're structuring those, it's important that you don't give, all right, we're just going to ignore this month entirely. Get them to pay something so that they realize that that obligation is still there.
Anything about how sort of pricing, because one of the things, like we mentioned Trammell Crow in the beginning, they were leasing office space and industrial space, and if they miss the lease, that space might sit for a year or 2 years. I guess, how have you seen sort of revenue management help owners sort of be ahead of the curve versus just occupancy falling or cutting too hard on rent? Have you any examples of that?
Yeah, and it's going to vary property by property, and to some degree, it's going to vary market to market. And I will say, as we're looking at some of the activity across the country, there certainly are spots where demand is still there. Texas is the prime example. There is still some demand out there. We've seen it in places like the Carolinas and Atlanta and Phoenix. I mean, there is demand there. There are other spots where, boy, you should not cut the price because there just is no demand at this point. And I'll put out there the three key examples are: there just is no demand in New York, and it does not matter how you're going to price those units. You're not going to lease to new residents. That's true in New Orleans. That's true in Detroit. It's true in some of the really areas that are very the economy is very hospitality driven. So what immediately jumps out at you is Las Vegas there. Doesn't matter how you're going to price that unit, you're not going to lease it, is most likely. So make decisions that reflect the conditions that you're actually in.
Speaking of that, where a lot of other people listen to the podcast are Texas centric. Maybe you kind of quickly talk about Texas. You mentioned demand is holding up materially better. Maybe you kind of talk to Texas as a whole, and then kind of the four major markets in Texas and kind of how they're reacting relative to the national averages, and then any other markets of note that you want to kind of expand upon, because obviously the headlines are Texas, Vegas, Detroit, New Orleans, like you mentioned, and Orlando obviously is a pretty big tourism convention market as well. But any thoughts on kind of how Texas is reacting in the four markets relative to the national averages?
Texas did, and circling back to the payment, did payments come in or not? Texas did way better than other spots on that measure. The states where the numbers look pretty normal relative to what we've seen in the past were Texas, North Carolina, Arizona, and Oregon. No real drop off in those areas. So we certainly see people are paying their rent. And as you look at this demand funnel in terms of website traffic and renter prospects showing up and making some inquiry about the properties, these same markets where the people are paying the rent, that's where the demand flow still seems to be there at a reduced level, but there is still some demand flow. I will say that looking at the individual Texas markets And in terms of, is there demand? Austin and Dallas-Fort Worth look a little bit better than San Antonio, and San Antonio looks a little bit better than Houston. And, Houston's been a problem child for a while now, and it's going to continue to be. And it's not just what's happening in the overall economy, it's what's happening in the energy sector, and is just getting slammed.
And that's on both demand as well as the collection standpoint.
Houston did okay on collections, but this is one that I would say on Houston, it's going to get meaningfully worse before it gets better.
Speaking of that, we are all, I think, generally relieved here that with the collection numbers so far for April. I do expect kind of our portfolio, and I'd imagine national or nationwide, that we'll see some level of deterioration as we go into May. Do you guys have some sort of base case on? One, do you agree with that thesis? And then two, do you guys have some sort of base case on what that might look like going forward as we go from April into kind of May, June collections?
We're with you in anticipating that probably May at least will be worse than April. And that's really based on the number of unemployed people on May 1st is going to be a lot bigger than it was on April 1st. But at the same time, those unemployment benefits are going to be kicking in. Some of the cash infusion that's coming from the CARES Act will be there. So there are, even if the households are unemployed, they will have some money. You just don't know to what degree they're going to spend that money to pay their rent. But our bottom line assumption, yes, is that May looks worse than April. And it wouldn't be surprising if that's true for June as well.
Yeah, Greg, do you see transactions that are already in the pipeline to be built, and those are already coming out of the ground? But do you see anybody tapping the brake? Have you heard any comments? Any developers, any builders are just saying we're going to put ourselves on pause?
Well, again, you've got a whole bunch of properties that are in lease up right now, and they're challenged. And as we look at the biggest 150 markets across the country, that's about 900 properties that are trapped in limbo. And the biggest block of that is in Dallas-Fort Worth, which accounts for about 10% of the national units that are in the leasing process right now. Looking past that, you've got close to 600,000 market rate units are under construction. So that's a lot to deal with once the market opens back up. I'll point out that we're not delivering a lot of that right away, because even though only a handful of cities have shut down construction, the fact is that you're struggling a little bit with materials, and you're struggling a little bit more in terms of keeping construction crews there. But the real problem is the municipal employees who do all the paperwork and come in and inspect the site. They're working from home too, so you can't get anything. In effect, pretty much all construction sites are moving toward shutting down at this point. So we're going to have to deal with that as it comes back in. And so that will be a challenge moving ahead. Product that's under construction already, it's very unlikely that anybody's going to walk away from that. But properties that have been announced or maybe even permitted, but if nothing's coming out of the ground yet, clearly we're going to go into pause mode on most of those properties. And we'll see how long that continues. But I don't hear of any capital source that is enthusiastic to put some more money into development right now.
Concessions, what are you seeing on concessions on that A product? And the question that everybody wants to know is when does everything go on sale? When is there going to be blood in the streets to start buying again?
Well, again, let's circle back to what happened in the Great Recession. If you're going to stay on the sidelines and wait for fire sale pricing, that's probably not going to happen. And you're just going to stay on the sidelines. And yes, there will be some adjustment, but I don't think it's huge. And look at the big picture. in terms of where does multifamily stand relative to other real estate product types and relative to other investment opportunities. It's still pretty good in the big picture. I was at a month or so ago at the Pension Real Estate Association conference, which is really kind of the last big event before everything shut down. And the phrasing that was used over and over and over again is multifamily and industrial are the cleanest dirty shirts in the laundry hamper at this point. And money's still going to go in the big picture to those products.
James, anything more to add?
Greg, coming out of all this, I mean, we've had a lot of negative things hit us very quickly. Any positives that you see in the next 3 to 6 months for apartment investors out there?
Well, you always learn some lessons with each downturn, and you see some things that you should have been doing to begin with, and you just didn't realize it when things were going well. And I think that involves, certainly in my world, it's pay more attention to the data and really pay attention to the real-time data versus the bigger picture. I think if you're in operations world, I think you're appreciating the residents maybe a little bit more than you did to begin with, and understand that the residents are really who keep you in business there. And if you're on the investment side, I think the takeaway is after a downturn is always understand risk and don't get too far over your skis on individual deals.
Any feedback from National Multifamily Housing Council about their efforts to try to change these forbearance agreements or find ways of trying to help some of these landlords that may find themselves with not enough cash to pay their bills starting in June or July?
Yeah, I mean, obviously, NMHC and other industry groups are working hard on this and selling that message that while we understand, take care of the renters, and that's important, but you got to understand the dominoes that you're pushing over and the potential problem that you could take if you don't provide some protection for the property owners and for ultimately the companies that own the debt on these properties. So we'll see how it comes together. Certainly, you do see congressional leaders are willing to have these conversations. Whether that goes in the direction we would like it to or not, we'll just have to wait and see.
A couple of years ago, we've had you on the podcast for many years in a row now, Greg. And a couple of years ago, I remember you said something when we were asking when the recession was going to come. You said you weren't sure, but sometime in the next 2 years or next 10 years, we're going to have 2 bad years. And because we're going to have 20, 30,000 units scheduled to deliver in that time period, talking about Dallas-Fort Worth. So obviously that's going to be 2020 and 2021 from what we can tell here. Do you have a sense, kind of put you on the spot, as we kind of wrap up, how deep you think this is going to go from delinquency standpoint and rental rate decline standpoint, and how long do you think this is going to last before we kind of get back to some semblance of kind of pre-COVID normal?
I'll take credit for being right in saying that there will be 2 bad years, but I will point out that I was also wrong in terms of just how bad those 2 bad years would be. So I think it's at this point, we're probably still looking at a V-shaped recession in that, things plunge, but then come back pretty quickly. Although, watch what happens with these employment numbers over the next few weeks. I think to date, we've been pretty industry specific in terms of what's shutting down. It's hospitality, it's retail, it's to some degree transportation. But at some point, this spreads into the broader economy, and big corporate employers in sectors that are not directly impacted start to cut back on their spending, whether that's equipment or staffing, just because they see dropping consumer demand for everything moving ahead. And then, the third phase would be this infects the financial system. And then that's a much deeper hole to fill in and that could take us from a V-shaped recession into a prolonged economic downturn. So I don't know how this is going to come together. For the moment, it looks short and sharp, but that could change very quickly.
Mike, you guys operate and manage thousands of doors. What's keeping you up at night?
Lots of things, but like Greg mentioned, I mean, obviously this is 17 million unemployed, and a 3-week span is obviously unprecedented. So that's pretty quick, and we've collected April. I'm hopeful that these stimulus checks start rolling as soon as next week is kind of what I've been reading, and obviously every government agency is stretched to the max. I know in Texas, the Texas Workforce Commission is seeing more demand in a 2 to 3 week period than I do the entire year for 2019. So I mean, everything's just being stretched to the nth degree. So I think all those things just kind of how low and how long is going to last. I mean, I think we're better positioned than a lot of our competitors, being that we kind of saw the disparity in the market, Paul, where cap rates were all the same. You go back and hear me say that thing repeatedly, like Greg was beating the drum. At some point, we have 2 bad years. I kept saying, just doesn't make sense to pay the same cap rate for Class A as you can in Class C, because the risk is different. And now we're seeing the collection risk kind of bleed through. And in reality, I think that's going to be further exacerbated if you own a property in a high crime area. Greg mentioned on a previous podcast we did with him about how all the C-class in South Dallas is jam-packed full, where historically they've been chronically vacant. I think you're going to definitely start seeing the economic vacancy come into higher crime, lower socioeconomic areas. I think that'll play out here over the coming months, and the disparate impact will be dramatically more felt in that segment of the market than something kind of in North Dallas that's a 2004 vintage deal will definitely fare a little bit better than something in South Dallas built in the 70s. I think those are things, but things that keep me up at night are just can I survive? Feels like, can we survive the next year? And if I can survive the next year, I'm pretty confident with the amount of money they're printing and flooding into the economy. At some point, there's going to be massive amount of inflation. So my kind of thing I've been saying is, I think in 10 years from now, prices are going to probably be triple what they were a month ago. The question is, can you hang out for the next year to then ride the wave of inflation that should be following all this generation of money?
James, what are you seeing on some of the properties that we've lent on in terms of the A, B, and C collections? Are they similar to what Mike is saying in terms of for April? And what do you think about going to May?
Yeah, across the portfolio, I mean, what I've seen is sort of A's are about 90% right now, B's at 80%, and C's are about 65 to 70%. And I guess it's hard to say that it's an absolute number, because a lot of those properties, they collect that way anyways. So most C properties don't collect all the rent on the first of the month anyways. So it's going to we're going to have to see at the end of April if they're able to get all the way up to 80 or 90%. And, agree with Mike that there's definitely going to be some areas that are hit significantly harder, especially if people just start, doubling up or, going back home to live with their parents and what have you. But in terms of positives, I see that, in comparison to almost every other commercial type, hotel, retail, office, I mean, I think there's just a huge gap now between those asset types and how fast those can be impacted in 1 month, where everything is shut down. Multifamily investors, people are still using our assets, whereas retail and hotels, there's nobody there. So, I mean, I know we have to get the rent out, but I think, that's probably something people are going to pay, especially as these stay-at-home orders stay in line. That's your only place that you can go right now besides the grocery store. So they can't really hide from us, I guess, while we're out there collecting rent.
No, that's absolutely correct. And that's some good insight. And I would imagine that Mike talks to his property management company, not one time a day, but 2 or 3 times or 4 times a day, just to kind of figure out where collections are coming in almost on not a daily basis, but almost like an hourly basis. And so people are paying more attention about what's going on, and I think trying to support their investments and their partnerships, and definitely getting to know their tenant base a little bit better. So some great insight. So Greg Willett, we certainly and very much appreciate you being on the Old Capital podcast, just because it is, just tumultuous times. I mean, it's something that we knew the last couple of years that something was going to come down the pike, but we didn't think it was going to come to be this dramatic. And you've offered us some great insight. So we'll try track you down here in the next 45 to maybe 60 days and kind of look back to what we said today to see if anything has changed. And we're going to kind of rely upon you to kind of give us some vision of what we can help other apartment owners and limited partners that have invested in apartments, to give them kind of a sense about what's going on, and maybe hopefully a big bear hug at the in the next 60 to 90 days that this is going to be over with and people are going to go back to work. Michael, anything more?
No, Greg, just definitely echo Paul's sentiment. I appreciate it. I don't know if you have any parting words of wisdom. I mean, obviously, I think we're users of multiple of the business lines that RealPage has out there. So we definitely appreciate the information that we get out of your suite of services you guys offer. Any other parting words of wisdom before we wrap this up?
It was great to join you guys today. I would just supply a reminder to folks who came into the industry during the course of the past decade and have never actually experienced a downturn, that in fact you do recover from these events, and again it's followed by an upside, and people make lots of money in that upside.
Well, I'm looking forward to making a lot more money because hanging around here with the warden, my wife, in our house for the last month is, as you can imagine, driving me batty and probably driving everybody else batty too. So again, James Zhang, we appreciate you being on. Greg Willett, thank you very much. Michael Becker, always a pleasure. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.